Well, greetings, SIE test takers. This is Dean Tenney. I'm coming to you from my studio in fabulous Las Vegas. I'm expanding the studio, so you might have a little background. I haven't put up the foam and some other stuff, so the audio, I've got a lot of reverb perhaps, but we'll try and lay down this lecture until I get the studio actually done. I'll let the perfect be the enemy of the good, so to speak. So taught an SIE class last week, and when I teach classes, I like to use that as kind of an excuse to put up some more content, more practice questions. This is practice questions for debt securities on the SIE. I'm not as concerned about, this isn't like, should give you an indication of where you're at in terms of passing, like the 4 practice exams or the playlist. This is simply wanting you to get comfortable with the answer sets and the types of things that you need to be aware of in terms of recognition. The SIE is primarily a test of recognition on the various items. All right, so let's get started. I put up last week some practice questions on equity. This week, I'm putting up some practice questions on equity. Please comment, let me know if you find this worthwhile, because I'm not going to go on and do, mutual funds next or options next if, this isn't something that you find useful. Okay, let's get busy. Let's get busy. Whoop. Slideshow from the beginning. All right, which of the following is issued at a discount and at issuance is a money market security? Now, the reason I added the at issuance as a money market security is I didn't want to even have you cloud your mind that this is potentially a treasury receipt or strip, right? So that's why I just added that phraseology to it. And you should definitely know treasury bills. Treasury bills are going to be issued at a discount, and they trade at a discount as well. They trade at a discount as well. And so the answer there is A. By the way, in treasury bills, you have no interest rate risk and you have no credit risk either, right? So treasury bills are considered to be risk-free because you don't have interest rate risk and you do not have any credit risk either. Best credit qualities out of the United States government. Which of the following is issued by corporations? Corporations, to fund their daily operations, issue what's called commercial paper. Commercial paper is large unsecured borrowing by corporations, large unsecured borrowing by corporations. It has a max maturity of 270 days or less, and it's considered to be a money market instrument. Very tough to know what money market instruments or securities are. That's high quality debt maturing in 12 months or less, right? So commercial paper. Since a bond was issued, interest rates have gone down. So listen, I always say this, if anybody ever asks about economics, finance, investments, and you want to sound smart, you should say it has a lot to do with interest rates. If you just shut up, you sound good. People say, what about them? You say they fluctuate. Is that good news or bad news? You tell me, well, it depends. It depends. So, you definitely have to know the inverse relationship of interest rates. If interest rates go down, you expect the bond to go up and you would expect it to be trading at a premium. By the way, I just noticed that I didn't put the slide numbers into the deck here. So if you have a question about one of these, just use the timestamp. Just tell me where it's at in the timestamp. And, I timestamp the lecture so you don't have to watch the whole thing. If you're looking for a particular practice question on a particular topic, you can just go to the timestamp. Which of the following is secured by marketable securities placed in escrow? So corporations issue equity and debt, and equity always precedes debt. Now, some corporations never issue debt, but if they're going to issue debt, they can either issue secured debt or unsecured debt. And you definitely need to know corporations' secured debt is a senior security in terms of liquidation. So what you have to be able to do on the SIE is rank securities from senior to junior. There's nothing more senior than, in bankruptcy and liquidation than the secured debt. Now, marketable securities placed in escrow is collateral trust bonds. Now, as I mentioned, I just want you to get comfortable with these answer sets. As we go through these practice questions, we'll see that the answer set remains the same, all these questions, but the question itself has changed. So in most of these answer sets, the wrong answers, the distractors of the technical for wrong answers, could be right answers to different questions. Which of the following is used to facilitate foreign trade? I would definitely know that's a banker's acceptance. By the way, flashcards are underrated as a study tool. You might want to grab a deck of 4x6 cards or 3x5 cards and make some flashcards out of some of the stuff that you find here in the practice questions. Bankers' acceptances, again, are issued at a discount, trade at a discount, and they're used to facilitate foreign trade. Which of the following is issued with a maturity of 2 to 10 years? So you have Treasury bills, which are less than a year, Treasury notes, which are 2 to 10, Treasury bonds, which are greater than 10, and Treasury receipts or strips. Treasury receipts are zero coupon bonds created by a broker dealer by stripping a Treasury bond of its income streams, its coupon payments. And then Treasury strips, the separate trading of registered interest and principal come directly from the US Treasury. But here, 2 to 10 years is going to be Treasury notes. Which of the following is most likely a GO bond? So you should expect a question or two about the distinction between GOs and revenues. And revenues are backed by user fees. I say, listen, don't get upset about the airport. You as a taxpayer are not supporting the airport. The people who use the airport are paying for the airport. The user's fees pay the interest and principal. You're not paying for the bridge. The people who use the bridge are paying for the bridge. You're not paying for the road. The people who are using the road are paying for the road. Public education is financed through taxes, GO bonds. So the big distinction between a GO and a revenue is GOs are backed by taxes. On local government, city, county, school districts, it's going to be a property tax. And, revenue bonds are backed by user fees. Since a bond was issued, interest rates have gone down. Again, this isn't a lecture. This is just some practice questions. But what you might want to do is draw a teeter-totter, a flat line. I have a whole lecture on it. Somebody just told me they watched it the other day. And, if interest rates go down, boom, there's our teeter-totter. We would expect the bonds to go up, and we would expect those bonds to be trading at a premium. Now, what I like about the teeter-totter or seesaw is the teeter-totter or seesaw turns judgment questions into aim and shoot, point and click questions. And anytime I can do that, I'm a big fan. So I would refer you to that lecture. By the way, right after this practice question is the lecture for bonds. So what I'm doing is putting the practice questions in front of the lecture. Maybe I should put it afterwards, but whatever. Which of the following are true? All the following are true of GNMA except. You should definitely know about GNMA because you are going to get tested on it. So GNMAs pay interest and principal monthly. Yes, it's the only investment we have that pays interest and principal monthly because what you're buying is proportionate ownership of a pool of mortgages. And as people make those interest and principal payments, that gets passed through to the GNMA holders. They're fully taxed. Treasury securities, direct obligations of the US Treasury, T-bills, T-notes, T-bonds, are taxed by the US government, not taxed by states. These are taxed by everybody. They're fully taxed. And unlike the other mortgage pass-through securities, which have an implied backing of the US Treasury, these are the full faith and credit of the United States government. No better credit quality than that. All the following true. They do not have interest rate. They most certainly do. If interest rates go down, people are going to refinance these mortgages and this thing will end sooner rather than later. And if interest rates go up, nobody's going to refinance the mortgage and these things will extend in life. So they certainly do have interest rate risk. They don't have credit risk, but they do have interest rate risk. Which of the following has no reinvestment risk until maturity? So Treasury receipts, Treasury strips, those are zero coupon bonds, zero coupon, no income stream. Now in a regular bond, you have to decide what you're going to do with the payments you're getting every 6 months. And your overall rate of return is going to be dependent on what you're getting with those payments. Here, you're not getting any payments, and so you don't have a problem until the very end. Hopefully, maybe that's the end of it. It's a target date investment. Maybe you don't have to reinvest it. But Treasury receipts, Treasury strips, any kind of a zero coupon bond doesn't have reinvestment risk until maturity. If the bonds, issued bonds come due on different dates, this type of maturity is known as serial. I had a student, they said the way they're going to remember this is like a serial killer. They come due at different times. So the issuer may borrow $100 million and say the first 10 million is going to be due 10 years from now, the second 10 million, 11 years from now, The third 10 million, 13 years from now, so on and so forth. So that's serial maturity. Series means different issuing dates, And a balloon just means a larger than normal payment within the maturity schedule. Which of the following is secured by real property? That would be mortgage bonds. Mortgage bonds, remember, secured bonds come ahead of unsecured bonds and liquidation of the corporation. So what we mean by real property is not only the building, we get the underlying real estate as well if we're a bondholder and we have to foreclose. So mortgage bonds are secured by real property. Which of the following is unsecured bond? A debenture is unsecured. That's just the issuer's full faith and credit. They're promised to pay the interest and principal. I joke, even in your personal situation, you may be an issuer of a debt security. You might have issued a debt security where there's collateral, like your house, and you pledge the house as collateral and you get a mortgage, or your car, you pledge your car as the collateral. But you might also have some unsecured borrowing. You might have like a Visa, for example. And the only thing that backs up your Visa is your promise to pay. Now, in a liquidation scenario, the unsecured bondholders come after the secured bondholders, but they come before the common and the preferred. If all the bonds come due at the same time, and that's typical, that's called term maturity. Term means all the bonds come due at the same time. Well, we said there's two risks when buying bonds. There's interest rate risk and there's credit risk. And below triple B is investment grade, but below triple B, bonds are said to be less than investment grade. Now, outside of the SIE exam, some people refer to those as junk bonds, but within the exam, we don't do that. And in the SIE test fantasy land in the real world, bonds, one man's junk is another man's treasure. Which of the following is least likely a revenue bond? Now, I'm just trying to get you comfortable with the language. This is basically the same answer set. And last time I said most likely a GO, and this time least likely revenue bond. But intellectually, that's kind of the same question, right? So I'm just trying to get you comfortable with phraseology. All the following are issued at a discount except the only money market security that is not issued at a discount is a negotiable jumbo CD, a certificate of deposit. All these other ones are issued at a discount. Which of the following is secured by rolling stock? That would be major movable equipment. A lot of airlines issue these. These are called equipment trust certificates. Rolling stock, major movable equipment. Now, I chose to use rolling stock so I wouldn't have to say equipment and give it away. So that's Dean's phraseology about rolling stock for the major movable equipment like airplanes. And that's just my way of avoiding saying which of the following is secured by equipment or certificates, right? So since a bond was issued, flat line represents a bond at par. Interest rates have gone up, very testable. That means the bond is going to go down. That's very testable, that inverse relationship of interest rates. And so we would expect it to be trading at a discount. Again, I'll refer you to the entire carve-out lecture I have on the teeter-totter or seesaw. Very easy to find in the playlist because it has a picture of a teeter-totter or seesaw, right? So this is what that's going to look like. The fulcrum of that teeter-totter, by the way, is the coupon, the nominal yield of fixed or stated rate of return. That doesn't change. All the following fluctuate in the secondary market except. So, when interest rates go up, the bond is going down. And when interest rates go down, the bond is going up. But the one thing that never changes is what the issuer has agreed to pay, that coupon rate. The coupon being 6%, let's say, that 6% doesn't change. All these other ones are. Now, remember, the coupon is also known as the fixed or stated rate of return. It's also known as the nominal yield. On these two practice questions, I decided not to actually put the answer set in because I decided what I would do instead in these last two is just show you how to do this. And there's not much math on the SIE, but there's a couple. You might have to use your calculator maybe once or twice. Again, I have another carve-out lecture on this. But if a customer is at a 7% tax bracket, I say, well, listen, you don't get to keep the entire 7%. It's kind of like your paycheck, right? What is your take-home pay? First, you got to pay your taxes, right? And so no matter what one of these you get, you're always going to need to take 100% minus the tax bracket. 100% minus the tax bracket. So you may as well just do that regardless of what the question is right out of the gate, because you know that you're going to need that. And so what I'm saying here is that if you 0.65 or 65%, I'm saying of every dollar you collect on a taxable, before you pay taxes on every dollar, you're going to have to pay 35 cents of that dollar in taxes. So you're really net left with 65 cents of each of those dollars, 65% of each of those dollars, if you will. You know, Oliver Window Homestead taxes or the price you pay for civilization. Now you're either going to multiply or divide. And if they're asking you tax-free, you're going to multiply. So what you're going to do is you're going to take the 7%, the taxable yield, right? A taxable bond 7, and you're going to times it by 100% minus the tax bracket. We did that earlier, and that was 0.65. And I say in your tax bracket, again, my math is terrible, so I'm going to get my calculator, and I'm going to take 7 times 0.65. And I say in your tax bracket, getting 7 taxable is the same as getting 4.55 tax-free. So I would be prepared on the exam to do that. Let's just label what we did here. And so what we did here was we had a taxable yield. Oh, gee whiz, I need to get some more coffee. And we multiplied by 100% minus the tax bracket. By the way, some of you are going to go onto a 6 or a 7, and you're going to get this again. So learn it once, get tested twice. And what we came up with here is the tax-free equivalent. And what I did here is I said I didn't make up an answer set because I thought I would just use the whiteboard to actually show how to go about that. Now, what you're hoping is when you look at the answer set, one of those choices is 4.55, right? So, all right, so let's clean this up. Now, the other scenario that's going to show up on the test is to go the other way. So here's the other way. So now we have a tax-free bond with 4, and we're trying to decide whether the customer should buy a taxable bond or a tax-free bond. So as we said, we're either going to multiply or divide. We said no matter which one of these we're doing, we're going to need 100% minus the tax bracket. So we might as well just always start out. The minute you get the tax bracket, be prepared for this kind of a question, right? So again, we're going to take 100% minus 35%. That's going to be necessary regardless of which one of these we're doing. And we get 65 again, or 0.65. Okay, so now we're going the other direction. So we're going to take the 4% tax-free, and we're going to divide. And what we're going to divide by again is the reciprocal, the 100% minus 35%. And so we're going to divide that by 0.65. And when we do that, what we get, I'll get my calculator here, is 4% divided by 0.65. I say in your tax bracket, getting 4% tax-free is the same thing as getting 6.15 taxable. So again, let's just label what we did here. What we did here was we took the tax-free yield, the coupon on the tax-free bond, and we went the other way. And what we divided by was 100% minus the tax bracket. And when we did that math, we ended up with the taxable equivalent yield. So in your tax bracket, getting 4% and not paying taxes is the same as getting 6.15. So again, the point here is if the corporate taxable yield is 6, he should buy the muni. If the taxable yield is 7, he should buy the taxable bond, right? So that's the whole point of doing the math, is to determine the suitability of a 4% muni, right? That's what we're doing, is determining suitability. And then the last kind of math I would be prepared to do in this category of practice questions. Whoop, I guess I didn't do that. I thought I had a current yield question for you. There we go. Did we miss that? I think Dean is losing it. The last one I want to show you is how to do current yield. And current yield is what an investment pays you divided by what it costs you. What it pays you divided by what it costs you. And so what it pays you here is 8%. Now, what you've got to be able to do on the test is take par, which is $1,000, times it by the 8% to figure out that this bond pays $80 in annual interest. That is something you should be prepared to do on the exam. So, whoop. Ooh. Interest. So if you can't do that, you're just going to be staring at it and saying, I don't know, right? So that's the first thing. We've got to figure out how much we're getting in interest from this bond. I'm just trying to make it look pretty. Looks like I blew it. Anyways, that's $80 in annual interest. Now I'm back in business. So now I take the 80 and I'm going to divide by the price of the bond. Now you definitely need to know the bonds trade as a percentage of par. You definitely know par is 1,000. So 90 means 90% of par. And so what that means is $900. So I'm going to put $900 there. And then when I do the math, current yield, by the way, if this was a stock, this is practice question on debt securities, but I'd be prepared to do this on a stock as well. And a stock, we take the dividend divided by the market price. So 80 divided by 900 equals 8.9. Good news, that's one of our choices here. And so there is our answer set. By the way, that's why you like math. There's no interpretation of a math question. You know, you either get it right or you don't. And I use my calculator. I'm not being facetious. My math skills are really bad. Okay, so I hope you found those practice questions helpful. There were about 20 of them. I apologize for not actually labeling the slides by number, but I'll timestamp them. And if you have a question, you can timestamp them as well. And as I mentioned, please let me know if you find the practice questions helpful, because again, I'm trying to put things on the channel that you find worthwhile. You know, so it seems like practice questions are pretty popular on the channel. So just remember, inch by inch, inch by inch, your SIE test is a cinch. Yard by yard, your SIE test is hard. All right, I'll see you in the next installment, which will either be mutual funds or options.